John Christmann, Apache CEO, discusses how hard it is to find workers and how much more he has to pay.
We came into this year and budgeted about a 15% increase on most of our service side. We'd seen a lot of the rig rates had adjusted last year. They started to really rise late last year. The frac crews had gone up in 2 increments last year. But it's the other things. It's the truckers. It's the hotshot service. It's the welders. It's the electricians. You know, all of those, the backhoes. You know, everything that requires people, there has definitely been pressure. And we budgeted about a 10 to 15% increase. We've seen that kind of come in as we had envisioned, you know, so far this year. It's going to be a battle. I mean, we're going to have to keep working the cost side and, you know, find ways to find efficiencies because there are shortages. There's a lot of people, you know, that are trying to do things in small areas, and it's going to be one of the challenges. There's infrastructure that needs to be built. You know, there's a group of companies that have been working together on how do we kind of organize to, you know, help do some of those things because, you know, the communities are going to need it. So, you know, it's one of the things we're all having to kind of come together and take on because, you know, those communities need some infrastructure.
Where do you think the workers come from?
Different, you know, hopefully most of them are local. We try to hire local in our programs.
But do they come from like construction area? Do they come from other trucking industries? Like I'm trying to get a sense of how you even find the humans to do those jobs.
Trucking's tight.
Yeah, trucking's real tight.
U.S. period, not just in our industry, right? In fact, it's probably having a spillover on other industries. So I think we'll have to find folks that are willing to move out to to West Texas. You know, I've lived out there most of my life. It's a great place to live. It offers a lot, and we'll need folks that are willing to move out there and, you know, because there'll be good jobs.
And so for you, 15% cost increases, do you expect that to continue for labor? And then what do you think for next year?
You know, we'll have to see. A lot of that's going to hinge on, you know, where prices are, where rig count is, where budgets are, and where the demand for equipment is. You know, we kind of baked in 15% this year. You know, even with that, we've been able to reduce costs at Alpine High. But, you know, it's going to be a function of where's oil prices and where's demand for, you know, rigs, frac crews, people, and where are the activity levels. As the rig count goes up, costs are going to go up.
That was Apache CEO John Christmann. Well, still with us is Torsten Slok, Deutsche Bank Chief International Economist. So the question you couldn't answer, literally, where does he get the workers?
Well, that's a really good question. The Beige Book yesterday pointed out that companies are now relaxing conditions on drug testing and relaxing conditions on criminal records testing. So there's just abundant anecdotes telling you that the labor market is relatively tight. And it's what we're seeing not only in the trucking industry, in retail, in healthcare, across the board in many sectors. It's just very clear that the labor market is getting very, very hot.
What does that tell us about tomorrow when we get the numbers for wage?
Yeah, so tomorrow, we have some details about the base effects, but the consensus expects 2.6, which is also our expectation. That still gives you on the chart year-over-year and average hourly earnings. That still gives you a relatively flat movement. Some other indicators like the employment cost index continue to roar ahead. So there's a very significant debate about why are some indicators still showing strong trend up in wage growth, whereas others are actually showing more flat development. But the big picture still is across all indicators. I think that's what the Fed is trying to tell us. We are seeing still a relatively tight labor market.
In certain areas, though. I mean, also in the Beige Book, we learned that consumer spending was deemed soft. You can't raise prices if consumer spending is soft. You may be able to deal with wages if you're an energy company, but the other part, not so much.
That's true, but remember the reason why the Bloomberg consensus expectation of GDP is so strong is not so much because of consumption, it's really more because of CapEx and the tax cut that we got and tax repatriation and the immediate expensing of CapEx. All that suggests that it's not really a consumption boom we're seeing here late in the cycle, it's much more a CapEx boom that's
Although it's hard to put those two things together, why companies are investing in CapEx if they don't have the demand coming from the consumers?
And then it's a two-speed economy.
That's true, but they have been underinvesting and CapEx has been low for a number of years, so they're catching up to where they should be. So one explanation, I know this is really excusing it from an economics perspective, but one explanation is that CapEx has been so low for a while that it needs to catch up, and that's why CapEx is so strong.
Fed hikes 3 or 4 this year.
We have 4 this year.
Still holding to that?
Absolutely. We still think that the economy is strong enough. If you look at consensus expectations on your Bloomberg screen, EC, FC, Go, you see that the expectation is that GDP growth will be about 3% for every quarter for the rest of this year, a little bit less. That's way above potential, which according to the CBO is 1.8. So we're still seeing well above potential GDP growth, which should continue to push the unemployment rate down, should continue to put upward pressure on prices and wages.